Welcome. If you're watching this today, you're here because you understand that markets don't move in straight lines, and the most significant shifts often happen when the majority isn't paying attention. Today, we need to talk about silver, and we need to talk about gold, not with excitement or fear, but with clarity and precision. Because something is building in the precious metals market that deserves your attention, whether you currently hold these assets or you're simply monitoring the broader financial landscape. Let me be direct with you from the start. This is not about getting rich quickly. This is not about guaranteed returns. This is about understanding a market dynamic that could create substantial volatility in 2026 and positioning yourself intelligently regardless of which direction that volatility takes you. The professionals who manage billions in assets are watching what I'm about to share with you. Central banks are watching it. Industrial manufacturers are watching it. The question is, are you? Over the next 25 minutes, I'm going to walk you through exactly what's happening in the silver market, why it matters for gold holders, and most importantly, what rational, disciplined investors should be thinking about right now. No hype, no guarantees, just analysis, context, and actionable guidance from someone who's been studying these markets for years and understands that your financial security matters more than any narrative or story. Let's begin. Silver is not behaving like a typical commodity right now. And when I say that, I don't mean its price is doing something dramatic on any given day. I mean the underlying supply and demand fundamentals are showing stress signals that historically precede significant price dislocations. Now let's talk about supply first, because this is where the story begins. Silver mining production has been essentially flat for the past several years. We're not seeing major new discoveries coming online. We're not seeing existing mines dramatically increasing output. In fact, many primary silver mines are dealing with ore grades that continue to decline, meaning they have to process more material to extract the same amount of silver. This matters because, unlike gold, which is primarily mined as a primary product, a significant portion of silver comes as a byproduct of other mining operations: copper, lead, zinc. When those base metal markets soften, silver supply can actually contract, even if silver prices are rising, because the economics of the primary metal drive the mining decision. Now let's look at demand, and this is where things get particularly interesting. Industrial demand for silver has been climbing steadily. Solar panel manufacturing alone has become one of the largest sources of silver consumption globally, and that demand is accelerating, not slowing down. Every major economy has green energy commitments that require silver, lots of it. Electric vehicles use significantly more silver than traditional combustion engines. The electronics industry continues to consume massive quantities. Medical applications, water purification, 5G infrastructure, the industrial use cases for silver continue to expand. But here's what makes this different from past demand cycles. Much of this industrial silver is not coming back into the market. It's not being recycled at the same rates as other metals. It's being consumed in applications where recovery is either technically difficult or economically unviable. This creates what we call a structural deficit. The market is consuming more silver annually than is being produced. That deficit has to be filled from somewhere. For years, that somewhere has been above-ground stockpiles, existing inventories held by exchanges, dealers, and institutions. But those inventories have been drawing down significantly. Registered silver stocks at major exchanges like the COMEX have dropped to levels that, historically, have preceded significant price volatility. I'm not going to give you a specific number and tell you it's a magic threshold, because markets don't work that way. But the trend is undeniable, and the professionals managing physical delivery obligations are absolutely aware of it. Now, combine this supply-demand imbalance with another factor, the gold-silver ratio. Historically, silver and gold have maintained certain price relationships relative to each other. These ratios fluctuate, sometimes dramatically, but they tend to mean revert over longer time frames. Right now, that ratio suggests silver is historically undervalued relative to gold. Does that mean silver must rise? No. Markets can remain irrational longer than you can remain solvent, as the saying goes. But it does mean there's a logical case for silver appreciation that doesn't require conspiracy theories or manipulation narratives, just basic supply, demand, and historical precedent. Here's where the squeeze potential enters the picture. When you have tight physical supply, growing industrial demand, declining inventories, and a market that's heavily financialized with significant paper trading activity, you create the conditions for a potential supply shock. If industrial users start competing more aggressively for physical metal, if investment demand increases even moderately, if any major holder decides to take large-scale physical delivery, the system could experience stress. We've seen this before in silver. 1980, 2011. Both times, the moves were sharp, volatile, and ultimately unsustainable at their peaks. But they were real. They affected portfolios significantly, and they caught many investors either unprepared or positioned incorrectly. I'm not predicting a repeat of those specific events. I'm telling you the structural conditions today share certain characteristics with those periods, and that deserves your attention and your preparation. If you hold gold, or you're considering gold as part of your portfolio, you cannot ignore what's happening in silver. These markets are connected, both fundamentally and psychologically, in ways that matter for your strategy. Let's start with the most obvious connection: investor psychology and momentum. When precious metals begin to move, they rarely move in isolation. A significant move in silver, particularly an upward move driven by supply concerns, tends to draw broader attention to the entire precious metals complex. Investors who might never have considered gold suddenly start researching it. Media coverage increases. The narrative shifts. This isn't speculation. This is pattern recognition based on decades of market history. Silver, because of its smaller market size and higher volatility, often acts as the canary in the coal mine for broader precious metal sentiment. If silver begins to squeeze higher on supply concerns, gold benefits from the increased attention and the psychological shift toward hard assets and monetary metals. Conversely, if silver disappoints or sells off sharply, it can create negative sentiment that spills over into gold. But there's a deeper, more fundamental connection you need to understand. Both gold and silver serve dual roles in the global economy. They're industrial metals. Silver more so than gold, but they're also monetary metals with thousands of years of history as stores of value and mediums of exchange. When concerns about currency debasement rise, when inflation fears increase, when geopolitical uncertainty escalates, investors historically move toward both metals. They're viewed, correctly or incorrectly, as safe havens and inflation hedges. Now here's what's particularly relevant about 2026 specifically. We're entering a period where multiple macroeconomic factors are converging. Global debt levels remain at historic highs. Central banks are navigating an environment where inflation risks haven't disappeared, even as growth concerns persist. Geopolitical tensions continue across multiple regions. The monetary system itself is being questioned more openly than at any time in recent decades. In this environment, gold has already attracted significant institutional interest. Central banks have been net buyers of gold for consecutive years. Retail investment in gold has remained steady. The price has shown resilience even during periods when traditional factors might suggest weakness. Silver, meanwhile, has lagged. But if silver catches up, if the supply situation forces a repricing, it could act as an accelerant for the entire precious metals sector. The capital flows that might enter silver could overflow into gold. The attention silver attracts could refocus investors on gold's role as monetary insurance. This is why even dedicated gold investors need to understand the silver situation. You don't have to own silver, but you need to understand how a silver squeeze could affect sentiment, capital flows, and portfolio dynamics across the precious metal space. There's also a portfolio construction angle here that's worth considering. Many sophisticated precious metals investors hold both gold and silver, but in different proportions based on their risk tolerance and objectives. Gold is typically viewed as the core, stable holding, the foundation of precious metals exposure. Silver is often held as a smaller, more speculative position that offers leverage to the overall precious metals theme. If you're currently overweighted in gold with no silver exposure, a silver squeeze could mean you're missing a portion of the move in the precious metals complex. If you're overweighted in silver relative to gold, you're taking on significantly more volatility risk. The point isn't that there's one correct allocation. The point is that understanding the relationship between these markets allows you to make informed decisions about how you want to position yourself based on your own financial situation and risk tolerance. One more critical connection. Both gold and silver are competing for the same capital in many portfolios. When investors decide to allocate a certain percentage of their portfolio to alternative assets or inflation hedges, they're often choosing between gold, silver, real estate, commodities, or other options. Capital that flows into silver in a squeeze scenario might come partly from new investors, but it could also come from reallocation away from gold or other assets. Understanding this dynamic helps you think through not just what might happen, but how to respond strategically rather than reactively. Let's zoom out and look at the bigger picture, because context matters enormously in understanding what we might be facing. Precious metals operate in long-term cycles. These cycles are measured in years and sometimes decades, not days or weeks. And within those long-term cycles, you get shorter-term volatility that can be dramatic, but is often noise relative to the larger trend. The last major precious metals bull market peaked in 2011. Gold hit its highs, silver spiked to nearly $50. Then both metals entered a multi-year correction and consolidation phase that lasted until roughly 2019. Since 2019, we've been in what many analysts consider a new bull cycle for gold. The metal has made new all-time highs. It's held those levels reasonably well despite various headwinds. Central banks have been accumulating. The fundamentals have remained supportive. Silver, however, has not confirmed this the way historical precedent might suggest. It rallied sharply in 2020 during the pandemic response, but then gave back much of those gains and has since been range-bound with occasional volatility spikes. This divergence between gold making new highs and silver not confirming is actually unusual historically. Typically, when gold enters a sustained bull market, silver follows with even more dramatic percentage gains because of its smaller market size and higher beta. The fact that it hasn't happened yet is one reason some analysts are watching silver so closely now. The question is whether silver is simply lagging and will eventually catch up, or whether this cycle is fundamentally different. I don't have a crystal ball, and neither does anyone else, but history suggests that when supply fundamentals tighten and demand remains strong, prices eventually adjust. The timing is always uncertain, the magnitude is always debatable, but the direction becomes increasingly probable as the imbalance persists. Let's talk about what happened in previous silver squeezes, because the lessons are valuable. In 1980, silver went from around $5 to over $50 in a matter of months. That move was driven partly by supply-demand fundamentals, but was exacerbated by the Hunt brothers attempting to corner the market. It ended badly for them, and for many investors who bought at the top, but the underlying supply concerns were real. In 2011, silver rallied from around $18 to nearly $50 in less than 6 months. This move was driven by post-financial crisis monetary policy, inflation fears, and a broader commodities boom. Again, the underlying fundamentals, supply constraints, industrial demand, investment flows, were real, even if the price spike overshot fair value. Both of these episodes taught us several important lessons. First, silver moves can be extremely rapid and violent in both directions. Unlike gold, which tends to trend more gradually, silver can gap up or down significantly in short time frames. Second, when silver moves, it attracts speculators who amplify the volatility. This creates opportunities, but also massive risk, especially for those who don't understand position sizing or risk management. Third, and this is crucial, the move's always correct. Both 1980 and 2011 were followed by brutal bear markets where silver gave back most or all of its gains. Investors who bought the excitement rather than the fundamentals suffered massive losses. The lesson isn't that silver is a bad investment. The lesson is that timing, position sizing, and emotional discipline matter enormously in this market. Now, let's consider the macroeconomic context we're in today, because it's different in important ways from both 1980 and 2011. In 1980, we were dealing with high inflation and high interest rates. Paul Volcker eventually broke inflation by raising rates to historically high levels, which crushed commodities broadly. In 2011, we were in the aftermath of the financial crisis with unprecedented monetary stimulus, but the global economy was recovering and inflation remained relatively contained. Today, in 2026, we're in a different environment entirely. We have massive debt levels that constrain how high rates can go without triggering financial instability. We have persistent inflation that hasn't fully normalized despite rate hikes. We have deglobalization and supply chain restructuring that are inherently inflationary. We have ongoing geopolitical tensions that create risk premiums in commodity markets. This environment is more structurally supportive of higher precious metals prices than either 1980 or 2011 because the exit options for policymakers are more limited. They can't raise rates indefinitely without breaking something. They can't credibly commit to sustained austerity given political constraints. They can't print infinite currency without undermining confidence. This doesn't mean precious metals must rise. It means the fundamental case is stronger and more durable than in some previous cycles. Understanding this context helps you separate signal from noise. It helps you avoid getting shaken out by short-term volatility if you're positioned for the longer-term trend. And it helps you avoid getting too euphoric during rallies, remembering that cycles always turn eventually. Let's talk about something that doesn't appear in any supply-demand chart but drives more market moves than most people realize: investor psychology. Markets are not purely rational systems driven by fundamentals. They're human systems driven by fear, greed, hope, regret, and every other emotion that affects decision-making under uncertainty. In precious metals markets specifically, psychology plays an outsized role because these assets don't generate cash flows. You can't value gold or silver the way you value a stock using discounted cash flow analysis. You can't value them the way you value a bond using yield curves. Their value is ultimately based on what others are willing to pay, which is deeply psychological. This creates feedback loops that amplify moves in both directions. When silver starts to rise on legitimate supply concerns, it attracts attention. Media starts covering it. Friends start talking about it. Social media algorithms start serving content about it. This increases awareness, which increases demand from new investors, which pushes prices higher, which attracts more attention. The cycle feeds on itself. At some point, and this is always where the discipline separates successful investors from unsuccessful ones, the move becomes disconnected from fundamentals. Prices rise not because supply is getting tighter, but because momentum is attracting speculators who believe prices will keep rising. This is when the most risk enters the system. This is when the people buying are the ones who will become the sellers at exactly the wrong time. The reverse happens on the downside. When silver corrects, initial selling triggers stop losses, which triggers more selling, which creates fear, which triggers capitulation. Moves that fundamentals might suggest should be corrections become crashes, because psychology amplifies the decline. Understanding this isn't about predicting exact turning points, it's about recognizing where you are in the cycle of sentiment and adjusting your behavior accordingly. Let me give you a framework for thinking about this. In the early stages of a move driven by fundamentals, you have informed investors acting on analysis. The crowd isn't paying attention yet. This is typically the best risk-reward entry point, but it's also the hardest psychologically because it feels like you're going against consensus. In the middle stages, the story becomes more widely known. Media coverage increases, more investors enter, but many are still doing their homework and making rational decisions. This is where the move gets validated or rejected based on whether fundamentals support it. In the late stages, everyone knows the story. Taxi drivers are giving investment advice. People who've never bought silver are opening accounts to get in. The conversation shifts from fundamentals to price targets and guaranteed returns. This is maximum risk, even though it feels safest because everyone agrees. Then comes the turn. Sometimes it's triggered by an external event. Sometimes it's simply exhaustion of demand. But the psychology flips, and everyone who bought late becomes a desperate seller. Where are we now in silver? That's the critical question. I'd argue we're potentially in the early to middle stages. The supply story is known among professionals, but not widely understood by retail investors. Industrial demand is real and growing, not speculative. Inventories are drawing down based on actual consumption, not hoarding. But here's what you need to watch for. When the narrative shifts from fundamentals to certainty, that's your warning sign. When you start hearing guarantees instead of analysis, when you see extreme price targets with no caveats, when the conversation becomes about getting rich rather than managing risk, that's when discipline becomes most critical. The sophisticated investor understands that market psychology will drive price swings that fundamentals alone can't explain. They don't fight this reality, they use it. They buy when others are fearful and fundamental value is being ignored. They trim when others are euphoric and prices have disconnected from reality. This requires emotional discipline that most investors don't possess. It requires you to act contrary to your instincts, because your instincts are programmed to seek safety and consensus and avoid the discomfort of standing apart. But this is how wealth is built and preserved in volatile markets. Not by being smarter than everyone else, by being more disciplined. If you currently hold silver, gold, or both, your strategic questions are different from someone considering entry. Let's address your situation specifically. First, take a clear-eyed look at your current position size relative to your overall portfolio. Do you know exactly what percentage of your net worth is in precious metals? If not, figure that out right now because you cannot make rational decisions without knowing your actual exposure. If your precious metals position is less than 5% of your portfolio, you're probably not at significant risk, even if we see substantial volatility. That level of exposure provides inflation insurance and diversification without creating vulnerability to a sharp correction. If you're at 10 to 20%, you have meaningful exposure that could substantially impact your overall portfolio performance. This requires more active monitoring and potentially some strategic adjustments based on how the market develops. If you're above 20%, you need to have an extremely clear thesis for why that concentration is justified, and you need to be prepared for volatility that could be psychologically very difficult to endure. There's no universally correct allocation. It depends entirely on your financial situation, your risk tolerance, your time horizon, and your conviction about the underlying thesis. But you must know your number. Second, if you hold physical metal, make sure it's properly secured and insured. This sounds basic, but in a genuine squeeze scenario where premiums spike and availability becomes constrained, the security of your physical holdings becomes paramount. Home safes, bank safety deposit boxes, allocated storage, whatever your solution is, verify it's appropriate for the value you're holding. Third, consider whether you're positioned for the scenario you actually believe is most likely. If you believe the silver squeeze thesis, is your silver position sized appropriately to benefit from it without creating unacceptable risk if you're wrong? If you believe gold is the primary story and silver is a sideshow, does your allocation reflect that? Or are you overexposed to silver's volatility relative to your conviction? Many investors hold positions that don't actually match their beliefs because they followed someone else's advice or got swept up in momentum at some point. This is your opportunity to align your portfolio with your actual thesis. Fourth, let's talk about taking profits. This is where discipline matters most. If you bought silver or gold years ago at significantly lower prices, you're sitting on substantial gains. The question is whether those gains represent excess exposure that should be trimmed or core positions you intend to hold through volatility. Here's a framework. Decide in advance what price levels or what changes in fundamentals would justify taking partial profits. Not selling everything unless the fundamental thesis completely breaks, but trimming exposure to lock in gains and reduce risk. For example, you might decide that if silver rallies 50% from current levels within 6 months, you'll sell 25% of your position. Not because you think the move is over, but because that level of gain in that time frame suggests we're moving into speculative territory where risk is increasing. Or you might decide that if inventories start rebuilding substantially, indicating the supply deficit is resolving, that's your signal to reduce exposure regardless of price. The specific triggers matter less than having them defined in advance. Because in the heat of a move, when prices are rising daily and everyone's talking about it, your ability to make rational decisions deteriorates significantly. Fifth, understand the difference between your core position and your tactical position. Your core position in precious metals is the allocation you plan to hold through cycles as insurance and diversification. This is metal you bought with no specific price target, that you intend to hold for years or decades, that serves a strategic portfolio purpose beyond just investment returns. Your tactical position is metal you bought based on a specific thesis about near-term moves. This is the portion you should be willing to trade around, take profits on, or exit if your thesis doesn't play out. Many investors make this mistake of treating everything as core, which means they never take profits, or treating everything as tactical, which means they have no anchor during volatility. Separate these in your mind. Know which portions of your holdings serve which purpose. This allows you to maintain your long-term positioning while still being responsive to shorter-term opportunities and risks. Sixth, if you hold both gold and silver, periodically rebalance based on relative valuations and your evolving thesis. If silver rallies dramatically and suddenly represents a much larger portion of your precious metals holdings than you intended, consider whether to trim and add to gold. If the gold-silver ratio reaches historically extreme levels, consider whether that presents a rebalancing opportunity. This isn't about constantly trading. It's about maintaining the risk profile you consciously chose, rather than drifting into whatever the market gives you. Finally, prepare yourself psychologically for what a genuine squeeze would feel like. It would be exciting. It would be validating. Everyone who doubted you would suddenly be asking how they can get in. You'd be tempted to buy more near the top instead of taking profits. You'd see price targets that seemed conservative yesterday look ridiculously low tomorrow. This is exactly when you need to be most disciplined. This is when your predefined rules matter most. This is when the difference between successful investors and blown-up accounts becomes crystal clear. The move up will feel like it will never end. Then it will end. And the move down will feel like it will never stop. Then it will stop. Your job is to survive both with your capital and your conviction intact. If you don't currently hold precious metals, but you're considering entering based on what you're seeing in the silver market, your strategic considerations are different but equally important. Let's start with the most important principle. Don't invest in anything you don't understand based solely on fear of missing out. The fact that silver might squeeze, that supply is tight, that industrial demand is growing, none of that matters if you don't understand the risks, can't tolerate the volatility, or are investing money you might need in the near term. Precious metals are long-term holdings, especially physical metal. They're insurance as much as investments. They're volatility dampeners in some scenarios and volatility amplifiers in others. You need to understand what role they would play in your specific portfolio before you allocate a single dollar. So let's talk about how to think about entry if you decide this is appropriate for you. First, determine your appropriate allocation size based on your overall financial situation, not based on how excited you are about the silver story. For most investors, precious metals should represent somewhere between 5 and 15% of a diversified portfolio. The exact number depends on your age, your income stability, your other holdings, and your personal conviction about the role of hard assets. If you're younger with steady income and decades until retirement, you might lean toward the lower end because you have time to recover from volatility and don't need as much downside protection. If you're closer to retirement with substantial assets and concern about currency debasement, you might lean toward the higher end. But don't exceed what you can hold through a 50% drawdown without panicking, because that level of volatility is absolutely possible in silver, and it's happened multiple times historically. Second, understand the different ways to gain exposure and choose what's appropriate for your situation. Physical metal, coins, and bars gives you direct ownership with no counterparty risk. You hold it, you own it, nobody can rehypothecate it or fail to deliver it. But you have to store it, insure it, and accept that buying and selling involves premiums and potentially significant transaction costs. Exchange-traded funds that hold physical metal offer liquidity and ease of trading, but introduce counterparty risk and management fees. You don't own the metal directly. You own shares in a trust that owns metal. In most scenarios, that's fine, but in extreme scenarios, that distinction could matter. Mining stocks offer leveraged exposure to metal prices, but come with company-specific risks, operational risks, and management risks. A mine can have labor issues, geological problems, regulatory challenges, all independent of metal prices. Futures and options offer even more leverage, but are absolutely not appropriate for most investors. The complexity, the margin requirements, the potential for total loss, these instruments are for professionals and sophisticated speculators only. For most people considering initial exposure, physical metal or a physical-backed ETF makes the most sense. Start simple. Add complexity only if you have expertise that justifies it. Third, think about timing and averaging in rather than trying to perfectly time the market. Nobody knows when the silver squeeze will happen, if it will happen, or how dramatic it will be. Trying to time entry perfectly is a fool's errand that will either keep you on the sidelines forever or push you in at exactly the wrong moment. Instead, consider dollar cost averaging over several months. Decide your total target allocation, then deploy it in chunks over 3 to 6 months. This reduces timing risk and prevents you from going all in right before a correction. Yes, if silver goes straight up from here, you'll have bought some at higher prices than if you just jumped in immediately. But if it corrects first, or chops around, you'll be averaging in at better prices and building your position with less stress. Fourth, combine any precious metals allocation with clear understanding of your overall portfolio strategy. Precious metals don't exist in isolation. They interact with your other holdings in complex ways. Sometimes they're negatively correlated with stocks, providing diversification when you need it most. Sometimes they move in the same direction. Sometimes they lead. Sometimes they lag. If you're adding precious metals, you're presumably taking capital from somewhere else. What are you reducing? Cash, bonds, stocks? That decision matters because it affects your overall portfolio characteristics. Ideally, precious metals replace a portion of your fixed income allocation, not your equity allocation, because they serve a similar role, capital preservation and downside protection, while offering different risk factors. Fifth, prepare yourself for what ownership will feel like psychologically. When you buy silver or gold, you're buying an asset that doesn't pay dividends, doesn't generate cash flow, and often doesn't move for long periods before suddenly moving a lot. This tests your patience and your conviction in ways that stocks or bonds don't. You'll go through periods where you question why you own this stuff, where it feels like dead money, where everyone else is making returns in other assets and you're sitting on metal that's going nowhere. Then, when it moves, you'll feel vindicated, but also anxious about whether to take profits or hold for more. Both feelings are uncomfortable, and both can lead to poor decisions if you're not prepared for them. Understand this before you buy. Precious metals are not for traders who need constant action. They're for patient investors who understand their role and can hold through the boring periods and the volatile periods without compromising their strategy. Sixth, if you're considering entry because you're worried about inflation, currency debasement, or systemic risks, make sure precious metals are part of a comprehensive strategy, not your entire strategy. Real assets matter, hard assets matter. But so do skills, human capital, productive assets, and cash flow. A well-structured financial life includes multiple forms of security, not just betting everything on one asset class. Finally, remember that you're not late. Despite what the narrative might suggest, precious metals cycles play out over years. Even if silver squeezes in 2026, even if gold continues higher, the long-term story around monetary metals, inflation, and currency concerns is likely to persist for much longer. This isn't your last chance. It's one point in an ongoing cycle. Make decisions based on rational strategy, not urgency. Now let's talk about the behaviors and decisions that destroy wealth in volatile markets like precious metals. These are not theoretical warnings. These are patterns that repeat every cycle, costing investors enormous amounts of money. Mistake number 1, over-leveraging your position through margin, futures, or options. Leverage amplifies gains, but it amplifies losses identically. In a volatile market like silver, leverage can wipe you out completely, even if you're ultimately right about direction. A temporary correction that would be just to pull back in an unleveraged position becomes a margin call that forces you to exit at the worst possible time. I don't care how confident you are in the silver squeeze thesis. I don't care how tight supplies are. Never leverage precious metals beyond what you can afford to lose entirely. The market can remain irrational longer than you can remain solvent. Mistake number 2, investing money you might need in the next 1 to 3 years. Precious metals are volatile. They can correct sharply even within bull markets. If you invest money you need for a down payment, for tuition, for emergency expenses, you create a scenario where you're forced to sell at exactly the wrong time. Only invest capital you can truly afford to lock up for the long term. This removes the emotional pressure that leads to panic selling. Mistake number 3, failing to take any profits during euphoric moves. Greed is the killer in late-stage rallies. When your position is up 50%, 100% more, taking some profits off the table is not missing out. It's risk management. You don't have to sell everything. But trimming positions to lock in gains and reduce exposure when sentiment reaches extremes is how you ensure you actually keep some of what the market gives you. Every cycle has investors who rode positions up and then all the way back down because they couldn't bring themselves to sell anything. Don't be that person. Mistake number 4, making decisions based on social media hype, message board predictions, or guru forecasts. The internet is full of people making bold predictions with no accountability. They'll tell you silver is going to $100, to $500, to the moon. They'll show you charts with arrows pointing straight up. They'll claim insider knowledge or secret information. Ignore all of it. Make decisions based on your own research, your own risk tolerance, and your own financial situation. Nobody on the internet knows what's going to happen, no matter how confident they sound. Mistake number 5, treating precious metals like lottery tickets instead of portfolio components. This isn't about getting rich overnight. It's about long-term wealth preservation and strategic positioning. The mindset matters enormously. If you approach precious metals like a speculation you hope will 10x your money, you'll make emotional decisions. You'll be vulnerable to hype, you'll sell at bottoms and buy at tops. If you approach them as strategic portfolio components with specific roles, you'll make rational decisions based on changing fundamentals and valuations. Mistake number 6, ignoring the tax implications of your trading. Precious metals held for less than a year are taxed as short-term capital gains at your ordinary income rate. Held longer, they're still taxed as collectibles at up to 28% in the US, not the lower long-term capital gains rate. If you trade in and out frequently, you're potentially handing a huge portion of your gains to the tax authorities. Understand the rules, structure your holdings and your trading accordingly. Mistake number 7, keeping all your precious metals in one form or one location. Diversification matters in how you hold metals, not just which metals you hold. Some physical metal you control directly, some in allocated storage, some in liquid ETFs for trading. If everything's in one place and that place becomes inaccessible, has a problem, or imposes restrictions, you've created a single point of failure. Mistake number 8, letting fear or greed override your predetermined strategy. You'll be tempted to abandon your plan. When prices are rising, you'll want to buy more at exactly the wrong time. When prices are falling, you'll want to sell at exactly the wrong time. The strategy you develop calmly before the volatility hits is infinitely more trustworthy than the impulses you feel in the heat of market moves. Trust the plan. Mistake number 9, investing in precious metals you don't actually take delivery of or can't verify. Unallocated storage, pool accounts, claims on metal you can't verify, these introduce risks that defeat the entire purpose of owning precious metals. If you can't verify what you own, if you don't have clear title, if someone else has claims on the same metal, you're not protected in the scenarios where precious metals matter most. If you hold physical, make sure it's actually physical. If you hold paper, understand exactly what counterparty risks you're accepting. Mistake number 10, paralysis by analysis or waiting for perfect entry points. On the flip side of jumping in recklessly, some investors research endlessly, wait for the perfect entry, and never actually act. They study every report, follow every analyst, wait for one more confirmation, and never pull the trigger. At some point, if your research supports an allocation to precious metals, you have to act. Not recklessly, not with money you can't afford to lose, but deliberately and with conviction. Waiting for certainty guarantees you'll never enter, because certainty doesn't exist in markets. These mistakes are not just theoretical. They're the lessons learned by investors who've lived through previous precious metal cycles. Learn from their experience rather than repeating it. Before we conclude, let's place this silver and gold discussion in the broader macroeconomic context, because these metals don't move in isolation from the rest of the financial world. We're living through a period of significant monetary and fiscal stress globally. Debt to GDP ratios in major economies are at levels historically associated with crises or major restructurings. Central banks expanded their balance sheets massively during the pandemic and are now trying to normalize without triggering recessions or market crashes. Inflation has proven more persistent than policymakers expected. The narrative went from transitory to entrenched uncomfortably quickly. Even as headline inflation has moderated, the structural forces driving it, deglobalization, energy transition, demographic shifts, haven't gone away. Interest rates remain historically low in real terms despite the hiking cycles we've seen. When you adjust for inflation, real yields are often still negative or barely positive. This environment historically supports hard assets because the opportunity cost of holding non-yielding assets is reduced. Geopolitical fragmentation is accelerating. The post-Cold War consensus around global trade and cooperation is fracturing. Nations are weaponizing currencies, payment systems, and commodity flows. This creates uncertainty and drives interest in assets that sit outside the traditional financial system. None of this guarantees precious metals will rise, but it creates an environment where the fundamental case for holding them is stronger than during periods of monetary stability and geopolitical calm. The question isn't whether these risks will definitely materialize into crisis. The question is whether your portfolio is positioned to weather various scenarios, including ones where currency debasement accelerates or where trust in fiat systems erodes further. Precious metals serve as insurance in that context. You don't buy insurance because you're certain your house will burn down. You buy it because the cost of being wrong is too high to accept. The silver squeeze story sits within this larger narrative. It's not just about industrial supply and demand. It's about what happens when investors start questioning the stability of paper claims and demanding physical assets. It's about what happens when monetary authorities are trapped between inflation and recession with no good options. Understanding this context helps you maintain conviction during volatility. It helps you see precious metals not as a trade, but as a strategic response to structural changes in the global economy. Let's bring this together with clear, actionable guidance as we close. If you currently hold precious metals, review your positions, verify your allocation percentages, confirm your storage and security arrangements, define your profit-taking rules before the next major move. Separate your core holdings from tactical positions. Prepare psychologically for volatility. If you're considering entering, determine your appropriate allocation based on your full financial picture, not based on excitement about potential squeezes. Understand the different forms of exposure and choose what matches your sophistication and situation. Plan to average in rather than timing a perfect entry. Integrate precious metals into a comprehensive strategy, not as a standalone bet. For everyone, avoid the critical mistakes we discussed. Don't overleverage. Don't invest money you need short-term. Don't ignore tax implications. Don't make decisions based on hype. Don't abandon your predetermined strategy when emotions run high. Understand that the silver situation in 2026 is significant but not guaranteed. Supply fundamentals are tight. Industrial demand is growing. Inventories are declining. The setup exists for a potential squeeze, but markets don't always deliver on fundamental setups in the timeframes we expect. Gold remains the core precious metals holding for most investors. It's more liquid, more stable, more widely held by institutions and central banks. Silver offers more volatility and potentially more leverage to the precious metals theme, but with correspondingly higher risk. Both metals serve roles in a properly structured portfolio. Neither should represent such a large allocation that their volatility threatens your overall financial stability. The broader macroeconomic environment, high debt, persistent inflation, geopolitical stress, currency concerns, supports the fundamental case for precious metals ownership as insurance and diversification. This isn't about getting rich. It's about financial resilience. Whatever happens in silver markets over the coming months, whatever happens with gold, the principles of rational investing remain constant. Know what you own and why. Size positions appropriately. Maintain emotional discipline. Take profits strategically. Avoid catastrophic mistakes. Markets will move. Narratives will shift. Prices will surprise. Your job is not to predict exactly what will happen. Your job is to be positioned intelligently for multiple scenarios and to respond rationally as events unfold. The opportunity in precious metals isn't about catching the exact bottom or selling the exact top. It's about positioning strategically for structural changes in the global monetary system and maintaining that position through cycles with enough discipline to capture the long-term benefits. You've now heard the analysis. You understand the silver supply situation. You understand the connections to gold. You know the historical context. You've received specific guidance for your situation. You've been warned about the critical mistakes that destroy wealth. What you do with this information is entirely up to you. Make your decisions based on your own research and your own financial circumstances. Consult with qualified professionals who understand your specific situation. Don't rely solely on any single source of information, including this one. But whatever you decide, decide deliberately. Decide rationally. Decide with full awareness of both the potential opportunities and the genuine risks. The coming year in precious metals could be significant. The silver squeeze scenario is real enough to warrant attention. The gold market continues to show strength despite various headwinds, but your financial security doesn't depend on perfectly navigating any single market move. It depends on consistent application of sound principles over time. It depends on discipline when others are emotional. It depends on patience when others are impulsive. That's what separates successful investors from everyone else. Not predictions, not luck, discipline. Stay disciplined, stay informed, stay rational. Thank you for your time and attention.